Understanding fair value gaps, the key to buyers. What are fair value gaps? So most beginner traders don't even know what is fair value gaps. Some of them know what are fair value gaps, but they don't know exactly how they will use them, and they don't know the right one to choose when taking their trades. So questions which they ask are, there are so many fair value gaps I see on my chart now. Which one will I use? Which one do I know will hold price to the upside or to the downside? How do I use them, and how do I enter the trade in the lower time frame? So don't worry, I'll be going over all these questions, and by the end of this video, you'll be able to use fair value gaps and take very nice entries. So the first question we ask ourselves is, what are fair value gaps? So fair value gaps are areas in the price where market moves rapidly and you have a very strong bullish candle to the upside or a very strong bearish candle to the downside. So in between that point, there is a particular level where the buyers and the sellers are accepting the same amount. This level is a fair value price. The market will come down to this area to activate some orders at this point and then send price to the upside to take out a particular high. For the bearish condition, you have a strong candle move to the downside, but in between this candle move, there is a particular price area where the buyers and the sellers are agreeing. So once you have this area, you expect markets to come to this level and then activate some orders that are present at this point, then continues in its intended direction. That is basically a time when the price is in a fair value. So in this point of fair value, the gaps that are created at this area, we call them the fair value gaps. So how do you identify the fair value gaps? So it is a three candle formation. This is one candle, second candle, the third candle. But in between this candle, you want to see the wick of the first candle. You can see this wick. Then you want to see a strong bullish candle to the upside. Then you want to see the next candle. This is one, two, three candles. Then in between the first candle and the third candle, you want to see that there is a gap in between the wicks. So when you have this condition like this gap in between the wick is a fair value gap because the buyers here, the sellers here are not agreeing at this price. Then later they may agree at this area. Then market will come, activate some orders that are present at this area, then continue in its intended moves. Because this is a bullish candle, this is a bullish candle, that is the green candle, then this is also the bullish candle, we call this a bullish fair value gap. So we expect markets to come to this area, then continues in its bullish move. And for the downtrend, it is the same thing but opposite direction. It is also a three candle formation. This is the first candle, second candle, third candle. You want to see the wick of the first candle, which is this one, and the third candle not touching each other. Then there is a strong price move at the second candle. So once you have that, the gap that is in between the third candle wick and the first candle wick is a fair value gap. So when market trades, then buyers and sellers can agree at this price level. Market can come to activate some of the sellers order and continue in its intended direction. These are fair value gaps. So these are areas where market can use in the future to send price to the upside or to the downside depending on how price moves. Understanding PD arrays is very important when trading fair value gaps. PD array means premium and discount array. So the premium array send market to the downside and the discount array send market to the upside. So let me use this for my example. Let's say we have market coming to the downside, straight to the upside. So if I draw from the highs up to this level over here, we expect market to come like this into the level above this 50 level. This 50 level, which is this 0.5 level, is also the 50 level. So the premium array is around here. So let's say this is a fair value gap, the one inside the premium array. We expect market to tap inside that level and then send price to the downside. For the discount array, send price to the upside. Let's say market is coming upside. So we want market to retrace up to a particular level. Let's say this is a fair value gap. So if I use my FIB2 to mark out from that level to this high, so we expect markets to come, enters into the discount array. You can see below the 50 level, which is the 50%, 0.5. Let's say this is a fair value gap. Then enters into that point, send price to the upside. So that is basically the purpose of the premium and the discount array. So the premium and discount array, which is the PD array that we used most in trading the fair value gaps, are just two. I use the swing points, which is the swing high and swing low. I also use the fair value gap itself. So how do you identify a swing high and a swing low? It's also a three candle formation. Let's talk about the swing high first. So you want to see wick of the first candle, wick of the second candle, wick of the third candle. So you want to see the wick of the second candle going above the wick of the first candle and the third candle. So this high is a swing high. And the fair value gap, of course, is also a three candle formation. You want to see first candle, second candle, third candle. The wick are not touching each other. The gap in between the wick of the third candle and the first candle is the fair value gap. So let me invert this. This is also the swing low, low of the first candle, low of the second candle, low of the third candle. You want to see the low of the second candle going below the first and the third candle low. So once you have that, that's a swing low. At the same time, the bearish fair value gap. Of course, this one will be a bullish candle and this one will be a bearish candle. So the gap in between them is a fair value gap. So these are the two important PD arrays that we use when trading this our fair value gap strategy. There are two market conditions to know a high probability fair value gap that has chance of holding price to upside or downside. Of course, there are different ways, but these two I'm about to show you is the highest probability market condition that I have seen in the market that works while trading this strategy. This is the first one. So here you can see this is uptrend. Market is creating low, high, low, high. But for market to continue, we have a small fair value gap at this point. If you take your fib from this point to this point, you will notice that this is a discount array. The fair value gap is inside the discount array, and this swing point is a premium array because it is a swing high. We have first candle, second candle, third candle. The high of the second candle is above the first and the third candle. So this is a swing high, you can see, and a swing high is a premium array. So we expect markets to come into this level and send price to the upside. But this can always happen in the market. Market comes into this area, send price to the upside. But what exactly are we looking for to know that this is a high probability fair value gap? So one thing you want to see is you want to see market rejecting from the premium array. At the same time, you want to see it rejecting the discount array, which is confirming to you that market is likely to continue in that uptrend. So you can see this candle that enters into this fair value gap. You can see how it closes above the fair value gap and the premium array. The wick is inside the discount array and also the premium array, but the body is closing above this fair value gap and the swing high. So once you have that, this is confirming to you that market is likely to continue in an uptrend. See the next candle, market push to the upside to take out this high. So this high is the highest high before this fair value gap. So this high will be our take profit. So this can be a 2-hour trade, this can be a 3-hour trade, depending on how long the downtrend is. So what you see over here is what I was doing in Euro USD in the past months, and this strategy gives me over 80% win rate. You can go back on your chart and backtest this. You will see that this thing that you see over here do not require daily bias, do not require higher time frame bias. When you see this on the 1-hour time frame, then you go to your 5 minutes time frame and look for your entry. So don't worry, I will show you how you can easily do that in this video also. So what I was doing was 1-hour time frame, 5 minutes time frame. That is the only two time frame that you need when trading this exact pattern that you see over here. And the last thing I pay attention to was the London section and the New York section. So I don't trade any other section except the London and the New York section. And I don't take trades before the news. I wait till after all the volatility news before I take any trade. So you can go back on your chart and see for yourself. This setup that you see over here is A plus setup. So don't worry, I will show you how you can easily enter the market. And for the bearish condition, so you can see over here, the fair value gap. This is the premium array, which is the swing high, but here it will be a swing low. Market taps into that point. You see a rejection, closes below these 2 points. Once you have that, then you expect the next candle to take out this low. So this is the downtrend condition. And the one I first showed you is the uptrend condition. So this is the second market condition. So you can see at this point, we have the same price action, bullish action. But if you look carefully at this point, we have the candles closing below the premium array, which is the swing high, and also the fair value gap. So at this point, you can see the closure. So here, this will make this a low probability trade because market is likely to continue in the downtrend. It is also likely to move to the uptrend. But why will you still consider this trade? One thing you want to see is you want to see the next candle that is created weak, that is to take out the low of the previous candle that closes below the premium arrays. So if you go to the lower time frame, this will be like a liquidity sweep. So once you have this sweep, this is making this a high probability setup. Although it is not as high as the previous one I showed you, because there it is the premium arrays and the discount array that is pushing the price, but here it is the liquidity sweep that is pushing the price to the upside. So once you have that sweep, you want to anticipate that the next candle that generates will push markets to the upside to take out this high. So this high will always be your TP. But sometimes it all depends on you. Sometimes it may not reach this high before it reverses to the downside. That is why you apply good risk management. When I was trading the Euro USD in the past months, I was only targeting 2RR. I was not targeting the highest point, the highest TP. So if you can target 2RR and you have over 80% win rate in that scale, so over here, this is the sell condition. It is the same thing, but in opposite direction. This will be a swing low, not a swing high, and it will be a discount array. This will be a fair value gap, but a premium array. So you have this candle closes below the two arrays. You have the sweep, a rejection below. Over here, you look for your entry. After this candle closes, you are not taking this candle. Although some people are good in taking this candle, but I will advise you to wait for this candle. So after this candle, you can look for your entry in this candle to sell, to take out this low. So before we continue, I want you to know that this video offers insights to improve your strategy. So if you have another strategy before, that is SMC strategy or ICT strategy or any other strategy that you use, you can combine what I just showed you in this video and with the examples I will be showing you later with your strategy and make a more perfect entry. If you have been gaining information so far, don't forget to like this video and subscribe to this channel for more videos like this. Don't worry, I'll be showing you simplified ways of trading the SMC and other strategies. Chart examples. Now I'll be showing you where to look for these setups. Then you will also learn how you will take your entries. So over here, this is the 1 hour time frame in Euro USD. And don't forget the time we are using is the New York time. So we want to be focusing our attention on two different time frames. The first time frame we want to use for our higher time frame is the 1 hour time frame. And for the entry, we want to use the 5 minutes time frame. While the second time frame I see that also works for this strategy is the 4-hour time frame and the 15 minutes time frame. So if you are using the 1 hour time frame for your higher time frame, you want to be using the 5 minutes time frame for your entry. And if you are using the 4-hour time frame for your higher time frame, you want to be using the 15 minutes time frame for your entry. So as I said, you don't need the daily to determine your direction in this strategy. All you need is just the 1 hour time frame or the 4-hour time frame. I was only trading after the news. So the reason why I do that is because before the news, market can be a little bit choppy, and when the news comes out, the real move will happen. But when I wait till after the news, then the market will come back to its initial movement and I will be able to take my trades and I will hit my TP. So before the news, you have to be disciplined and stay away fully from your chart, because sometimes you are likely to see this setup showing up on your chart. So if you look carefully, this is May 29. This is 2 days ago. This is 1 o'clock candle. Let's say this is the first candle. You can see this is the 3 o'clock candle. This is the London section because I am using the New York time. So from 2 o'clock to 5 o'clock is the London section in New York time. So this section is a very good section to take trades. Unfortunately, we have a fair value gap that is forming exactly at the point. So I will use my rectangle tool to mark out this fair value gap. So the swing point to the low or to the right does not matter. You can see over here, this is a swing point, but the candle is not even touching the area. But the most important thing we want to pay attention to is that fair value gap. What is market doing inside that fair value gap? We have this candle closes above the fair value gap, which is confirming to us the market is likely to take out this high. So the highest high or the lowest low before the fair value gap will be our take profit. So you can see at this point, once this candle closes, this 4 o'clock candle, we want to pay attention to the 5 o'clock candle to wait for this candle to close. And after the close of this candle, then you can take your trade with the next candle. So this one will tell you the direction of where market is going. So you can see at this point, it closes above the fair value gap. Then we can look to take our trade. If we use the 1 hour time frame for our hour time frame, we drop to the 5 minutes time frame for our entry. So 5 minutes time frame. So this is the 5 o'clock candle. This is the candle that starts the 5 o'clock candle. So let me remove that line. So what are we looking for our entry? We want to see a fair value gap that is curated and the market should close above that fair value gap. The fair value gap can be inside the fair value gap from the higher time frame. It can also be a little bit above or below this fair value gap from the higher time frame. So let me remove this fair value gap. If you look carefully inside this area, we have a fair value gap at this point. So if I use my rectangle tool to mark out this fair value gap in the lower time frame, you want to see market closing above that fair value gap. You can see that inside the 4 a.m. candle, the market has already closed above the fair value gap. So what you want to wait for is this 4 a.m. candle to close completely. Once you have the close, then on the 5 a.m. candle, you want to take your entry immediately. So over here, your entry will be at this point. This is the close of the 4 o'clock candle. This is the 5 a.m. candle. Entry will be here. Your stop loss will be below this swing. This is a swing low. Then your target will be 2RR, but your first target will be high in the higher time frame. That is the high that was created before the fair value gap in the higher time frame. So once that is taken out, you can break even. You can close all your trade at that point, or you can target 2RR. So once this is taken, you can break even. Then you wait for market to deliver your 2RR. So market can do two things. Either it goes to the 2RR as you see over here, or it reverses to take you out on a break even. But you don't panic because you know that market will still give you this opportunity all over again. So once you take your profit, then you look for another opportunity once it shows up. So now let me show you another example in the previous day so that you will understand better. May 28th, that is the day before the example I first showed you. So I told you, you see this almost every single day. So you can see at this point, this is the 7 a.m. candle and this is the 9 a.m. candle. So this is a New York section using the New York time. This is New York time. So inside that area is the New York section. As I told you, you only trade London and New York section. So over here, this is the first candle, second candle, third candle. The wick of the first candle and the third candle did not touch each other. So that is a fair value gap. To this point, draw that out. So you want to wait for this 10 candle, this 10 a.m. candle to close. You can see how it wicks the fair value gap. After the close, then you want to anticipate that this 11 o'clock candle will take out this low. this low to the left. So if I drop to my 5 minutes time frame, because this is the 1 hour time frame, so this is the 11 o'clock candle. Let me remove that. You want to look for a fair value gap that market will close below. So you can see at this point, we have a fair value gap here. The wick of this candle and the wick of this candle is not touching each other, but market did not close below it. So market continues. Then you have this strong bearish fair value gap to the downside. So what do we anticipate? We anticipate the market will come to retest that fair value gap to target the downside. So if I mark out this fair value gap against the 11 o'clock candle, this is the 11 o'clock candle, your entry will be at the close of this fair value gap. So once this 10 o'clock candle closes, you will have your entry here. The stop loss can be above the fair value gap. Why? Because this fair value gap is a very long fair value gap to the downside. But the safest place to put your stop loss is above this swing. But here, I'll be using this fair value gap. Then your first target will be this low to the left, this one that we drew from the higher time frame. And once it's taken, you can close your profits completely. After you break even, you can target 2R. So you can see how market hits your 2R at this point. So once you have that, then you close your total trade. So this is exactly what I was doing when I was trading this strategy in Euro USD in the past months. So let me show you the second condition. It also works, but it is not as accurate as the ones that I have been showing you. First condition, fair value gap. Here we have a news to the downside. This is the 5 o'clock PM candle, which is 1700. And between the 4 o'clock candle, which is the 4 PM candle, and the 6 PM candle, we have a fair value gap. So this is practically not a London or New York section, but it still works. So over here, this fair value gap, we also have a sweep of the previous candle's high. This is the sweep of the previous candle's high. And our target will be the low of the fair value gap. This low, our target. We drop to the 5 minutes time frame since this is the 1 hour time frame. So the 5 minutes time frame. So over here, this is the 10 o'clock candle, this is the 9 o'clock candle, and this is the fair value gap that we have from the higher time frame. So what do I say we pay attention to? We pay attention to fair value gap inside the fair value gap. So over here, this is a small fair value gap on this point. So we anticipate market to sell from this point, your sell limit here at this fair value gap or a little bit lower. Your stop loss will be around this point. Then you target first, this low is your initial low, but as I said, you can first target 2RR. You see how market delivers that. Then we have news to the downside. So as I said, you are advisable not to trade before news. I am just showing you this one to let you know that it is also present in the market. You cannot easily see this type, but once you see them, they also plays out. But the first one I showed you, those are the high probability setups that you can take when trading these markets. I hope you understand better how to use fair value gaps now. So after this video, I want you to go back on your chart, backtest this strategy because you will see a lot of opportunities that you are missing if you are not utilizing fair value gap with your strategy or if you are not trading the fair value gap. If you find this video helpful, don't forget to like this video, subscribe to this YouTube channel, turn on the notification bell so that you get notified anytime I release a new video. You can also check out my other videos that are displaying right now on your screen. Thanks for watching.